Have you ever asked yourself if you're investing in the right things and in the right way? If you're like most people, you're probably wondering if you took the right chances in your past and if you're taking the right decisions now. Or you already regret your past choices and want to be sure you're doing the right things now. So in today's video, we're going to cover all that, going from investing in the stock market to whatever other financial decision like buying a house, starting a business, and investing in real estate. And we'll go through all decades of your life from your teens up to your retirement. Keeping this a relatively short video is going to be challenging, I know, because we're going to touch so many aspects and so many decades, but still try not to skip any decade in this video because in the decades before yours, there are certainly things you can do too. My name is Rick, an Italian engineer with a love for finance, here to make finance and investing easy for everyone. So if you're new here, join our community by subscribing to the channel and you won't regret it. But now let's start with the first decade, which is going to be really quick, and that's your teens. You might be wondering, why am I including the teens if people this age are usually busy with school and want to have nothing to do with investing? Well, fun enough, I received a comment on one of my last videos from Rude Boy, a 13-year-old that is investing and saving every month. And I find that truly wonderful. Great job, Rude Boy. Nevertheless, this doesn't necessarily have to be the priority for all teens. Above all, if saving and investing means they have to leave school and start working. I'm a fan of do-it-yourself kind of people that learn life through their own experience, but still, I believe that when kids leave school too early, in most cases in the future, they're gonna have a harder life because they don't have high qualifications. So except if you're such a bright kid that you know exactly what your future is gonna be, and by the way, you might think you know that, but probably you're gonna change your mind 1,000 times in your life. Your best investment in your teens is gonna be to finish high school, work on the side to earn your first money, and learn what it means to manage money. So make yourself a budget, part of it for fun, and part of it saved and possibly invested. Moving forward 10 years, now you're in your 20s. You're studying at university, or maybe you're working, and you're wondering if you're going the right path. So here are my 2 cents. The younger you are, the more you should focus on internal assets and less on external assets. So what do I mean by internal assets? Your skills and experience. I know this might sound surprising to some of you. Most people say, just focus on investing in the stock market as much as possible in your 20s because you actually have the longest life in front of you to make your investment compound. And yes, that is true, and we'll talk about it in a bit. But I believe that most of your energy and money should go into building your skill set and your qualifications because the return of investment that you're gonna have through this over time is more than the compound interest of the investments that you can actually afford in your 20s. Look for all possible ways to improve your knowledge in the field that you like. For example, if you want to become a successful real estate investor in the future, take a real estate license and start learning the ropes as an agent first. And worry about the salary, yes, but don't make it the main criterion for choosing a company. You want to be in a company that invests in you and improves your skills. And if they stop doing that, move to a more challenging job. And if you believe you want to become an entrepreneur, well, good for you. The internet has more information now about this than you could ever find elsewhere. So choose a path, learn what you can from the internet, but the sooner you start acting on it, the better. Now, regardless of this, you still have to think about other investments, right? If you have money, you can't just spend it all on courses. So what do? The first thing you want to focus on in your 20s is paying off debt, which, by the way, is an investment. That's why I included it here. It's like an investment with a rate of return equal to the interest rate that you're paying. So student loans, credit card debts, whatever debt you have with a high interest rate than 4% should be paid before anything else. Remember that paying off debt is important also because now you're starting to build your credit score. Your credit score will determine a lot about your financial life. Whether you can get a loan, the interest rate of the loan, insurance rates, employers, and all type of things. Another thing you absolutely need to do is to take advantage of these years because now your expenses are probably not going to be high. Maybe because you live with your parents or because you don't have a family of your own. So now it's the perfect time to invest as much money as possible. Real estate is going to be a hard field to start with in your 20s because of initial capital and low credit score, but still it's doable. Nevertheless, many people find it helpful to learn the ropes as a real estate agent first. And the stock market is also a great choice. Much easier to get into, by the way, and if you do it, you should invest in index funds in ETFs. If you want to know more about ETFs and how to invest in the stock market, you're going to find a lot of material on my channel, and that's, by the way, the topic that I always talk about in my videos. So just subscribe and you'll get all the information you need and also a lot of Google files for free. So why is investing in your 20s so important? We said these 2 words before, and they are compound interest. Compound interest is good interest that builds on top of itself. If you compound $10,000 over 10 years at 9% per year, it turns into just under $24,000. But give yourself 50 years it amounts to over $740,000. Now, imagine the situation. Two people. One is 25 and one is 35 years old. The 25-year-old graduate earns $60,000 and want to retire by 65. They have zero to start and plan to invest 10% of their income in a 401k. Fast forward 40 years, their account is projected to be worth almost $2.2 million. Now, on the other hand, the 35-year-old professional earns $85,000, much more than the 25 years old, and wants to retire by 65. Even increasing their contributions to 15%, they're still only going to have $1.9 million in the same time frame. So remember, compound interest is the key to wealth. So 10 more years are passed and now you're in your 30s. Exciting time. I am in my 30s and honestly, I still think I'm 20, but my hair thinks otherwise. Well, that's a sign of wisdom, they say. But anyway, if you're in your 30s, you're hitting all your major milestones. Marriage, home ownership, maybe even kids, and hopefully a job you enjoy. And this, your job, is the first point. Your 30s are the most important decade for your career, and if you find yourself working in a field that doesn't really fulfill you, this is the time to change things and fix your career. But assuming you have the right job, where should you put your money in your 30s? I'm gonna start with something that goes against what most famous people say, and before thinking, what is this guy saying? I'd rather listen to Grant Cardone or Robert Kiyosaki. Let me explain my reasons. I think in your 30s, at the latest, you should buy your own house or apartment. And no matter what they say, your house is an investment if you do it in the right way. So what is the right way? Many people buy their dream house with the idea that what you buy must be what you're gonna enjoy your whole life. So they charge themselves with a mortgage that takes away 40-50% of their income, and they end up having no money to invest for the first 30 years of their adult life. I don't agree with this. I think your first apartment must be much cheaper than your dream and serves the simple purpose of building up your equity, your wealth. So that the money you spend for the mortgage as principal goes back to yourself as home equity instead of disappearing as rent. And when the time comes that you have enough equity and also some more savings, you can step up and buy something bigger while renting your first apartment at a price that covers the mortgage. The only reason why you shouldn't want to do this, in my opinion, is if you need to be mobile because you are an entrepreneur. So in this case, you don't want to be bound to a city or a house. So why do I think that the house is an investment? One, it forces you to use part of your income in something that builds up your equity and your wealth. Two, real estate increases in value over time. Three, you fix your mortgage payment as opposed to renting, which is going to cost you more and more in the future. And four, as soon as you have built enough equity, it's easier to buy another place and you can transform your apartment into a money-making machine. Next to the house, your 30s are a decade in which you should seriously think about how to transform what you learned in your 20s into a business. Whatever you learned at work, if you enjoy it, there is a way to turn it into a business. So if you fancy the idea of having your own company, the 30s are the sweet spot where you are not too inexperienced, but also not too full of responsibilities. If you instead want a normal or a corporate job, you should absolutely think about retirement and start contributing and maxing out your 401k and your Roth IRA. I'm not going to explain in detail what they are now because you can find everything in this video of mine, which is also divided in decades and explains everything you need to know to build up retirement savings. So you can watch it later if you want, and I'll link it in the description below. Now, next to house and retirement plans, you absolutely need to invest in the stock market, and you're going to do that through ETFs, exchange traded funds. That's the easiest way to invest in a wide range of successful companies and guarantee a good return in the long term. As a general rule, the younger you are, the more you should invest in stocks and ETFs and avoid low return safe solutions like bonds. So to invest in ETFs, you gotta use your Roth IRA as much as possible because you're gonna have tax advantages, but don't stop there. Use a normal brokerage account for all the rest. Try to invest as much as possible. I invest around 50% of my income, and you're welcome to do the same, of course, if you can, but at least you should go for 15-20%. Other asset classes that you can invest in are commodities like gold, which I don't really suggest, real estate, which is great and you're always welcome to start with, and future and derivatives, from which, if you ask me, you should keep yourself as far away as possible. Moving on now to your 40s, if you have kids that are probably busy with school, and hopefully you have more time to think about yourself and reflect about your life. And one thing that you should definitely think about is subscribing to my channel because you like the topic, and there is no better way than hearing about it from the Italian twin of Manu Ginobili. But after you've done that, you've got 4 other priorities. Number 1, in your late 40s, early 50s, you're probably at the peak of your earning years, so you really need to go 100% into investing to push your wealth building to the limit. The first place where your investment money should go, assuming that you paid all your debts with an interest rate higher than 4 to 8%, is the stock market. Keep on investing on broad-based index funds like VTI or VOO if you have complete trust in the American stock market, or world ETFs if you want to have world coverage. Diversification here is key if you're not Warren Buffett. So invest in the stock market, but move also to other assets like real estate. If you bought your first apartment 10 years ago and saved enough, you should already be able to buy a new place and rent the first one. If instead you jumped into real estate soon enough and bought at least 2 or 3 apartments, well, you probably wouldn't be watching this video now because you're already out there looking for new deals to scale up and buy more properties. Now, the second priority is retirement savings. So next to the normal stock market investment, keep maxing out your 401k and your Roth IRA. The third priority can be saving for your kids' college. I say can be because you don't have to do it if you don't have enough savings for yourself. Remember, finance works just like oxygen masks in the airplane. You can't help your kid with his mask if you don't help yourself first. Anyway, if you do want to help your kids to go to college, you want to start doing that with good 3-4 years in advance. So while your kid is still in high school, you need to start thinking about a 529 plan, which is a tax advantage account that can be used to pay for qualified education costs. Now, priority number 4 is to think about your health. Seriously, investing in your health is the best investment you can do, and it's also a financial investment because if you're healthy, you're gonna have to pay for less medical expenses in the future and you are more free to work for more income. Probably in your 20s and in your 30s, you could do whatever you wanted. But now in your 40s, you're probably gonna start to feel the consequences if you didn't do enough. Believe me, I feel it in my 30s. Besides moving a lot, jogging, or even walking instead of going everywhere with a car, even around the corner, you should start investing in an HSA, a health savings account, which allows you to set aside pre-tax money for future qualifying medical expenses. The big mistake you should avoid in your 40s is spending too much on your kids. It could be, for example, that you pay too much for their college and you don't have retirement savings, or even just spoiling kids with too many clothes and expensive things. Remember, at least that's my philosophy, that every time you make something too easy for your kids, something too hard will come up at some point in their life. 10 years forward, you're 50 now. I'm still not there, but I think it's a great decade. You probably have grandchildren already and you're reaching the top of your career. In your 50s, you reach the stage of your life in which you can't really allow yourself as many risks as before. So diversification is going to be extremely important now. And for the stock market, this means starting investing in bonds next to stock equities. A great way to do this is by using the simple but incredibly effective trade fund portfolio. And if you want to know how to easily build this portfolio depending on your age, I'm going to link this video of mine in the description below. Diversification doesn't only mean diversifying in the stock market. Remember that in your 50s, you can contribute more in your 401k and in your Roth IRA. And you should always max out these contributions. Plus, by now, hopefully you own a good portion of your home equity, so you should think about buying a new property to rent out to generate passive income. This can only work though if you can have a mortgage whose monthly payment is lower than the rent you can get out of it. And not just $1 lower, you're gonna have to pay taxes, reparations, and so on. So don't start a new debt like a mortgage if it's not a good debt that gives you a positive cash flow, and fix the duration of the interest rate for as long as you can, possibly the whole mortgage time. Since your kids are probably out of college and out of the house, you're probably gonna have more money available and you should get it into your retirement accounts. Another investment you can make is to avoid car leasing and expensive car financing. Leasing is for sure the worst thing you can do. Remember that rich people ask how much and poor people ask how much upfront and how much per month. So with leasing, they truly found a way to dry you off of all your savings little by little thanks to affordable monthly payments. So don't make this mistake. In general, get rid of debts. In your 60s, you're finally close to retirement, so there is not so much time to play around with investments. I'm gonna keep it short here because otherwise it would be a repetition of my video about how much money you should have by age. But basically, in this decade, you have 2 investments to do. One is your retirement, and one is your family. You need to check your retirement savings, and there are plenty of retirement calculators available online. So just Google retirement calculator and you can choose whatever you find. Obviously, it's time to learn about Social Security and Medicare, because these are 2 programs that are going to have a big influence on the quality of your retirement. But apart from that, and probably also investing more in an HSA, which is a health savings account, you should think about your family. The best investment by far that you can make in this age is spending quality time with your children and your grandchildren. I know you might be expecting more, but actually thinking about retirement and family are the two most important things that you should do in your 60s. If you enjoyed this video, consider subscribing to my channel and dropping a beautiful like. And remember, whatever you decide to invest in, it's always better than doing nothing. But be ready to make mistakes because they're part of the journey. Here's Rick Dago, guys. I wish you a wonderful evening and I'm looking forward to seeing you in the next video. Ciao.